Welcome everyone to the third in our series of informative webinars on exit planning for business owners. Today's webinar will deal with how you, the business owner, can prepare your business for a sale to an outside third-party buyer. My name is Mike Desiato, and I'm a tax partner with the firm of Cherry Bekaert LLP. Cherry Bekaert is a top 25 accounting and advisory firm headquartered in Richmond, Virginia, with offices throughout the southeastern United States, and most recently now in Austin, Texas, and Nashville, Tennessee. In addition to being a CPA and a CFP, I'm also a certified exit planner and have been assisting my clients with planning for the single most significant financial event in their lifetimes, that being the successful exit from their companies. As the quarterback of the client advisory team, my job is to keep the client's advisors on track and on task toward the goal of a written exit plan that is consistent with the client's financial objectives. And as a team member myself, I focus on the tax issues and techniques to minimize the tax bite in the exit planning transaction. Today, I am privileged and honored to be joined by Rick Becker, MBA, and Mark Solomon, Esquire. A little bit about Rick and Mark now. Rick Becker is the managing director and founder of Cross Keys Capital, an investment banking firm located in South Florida. In addition to holding an MBA, Rick is also a former CPA and CMA, which enables him to bring a wealth of financial and tax knowledge to privately held businesses. His extensive background in valuation methodologies, coupled with his personal relationships with over 400 of the leading private equity groups focused on the middle market, enables Rick and Cross Capital to better position its clients in the eyes of both strategic and financial buyers. Mark Solomon is a partner with White Sirota, Helfman, Cole & Bierman in South Florida. Mark focuses his practice on representing mid-sized companies and entrepreneurs in all stages of development, from formation to the operation, financing expansion, and the structure and execution of their exit and succession plans. Unlike most M&A attorneys, Mark is uniquely qualified to assist business owners in the sale of their companies, as he brings his personal experience as an entrepreneur who owned and sold his own business to a publicly traded company. In today's webinar, we're going to talk first about choosing the right professional team, and then we'll move then to the goals of the M&A process, and then to managing and structuring consideration and timelines for the sale of your company. We will then wrap up with a lightning round where we recap some of the major takeaways of the presentation, and then, time permitting, we'll take some questions. Okay, let's get started. Let me spend a few minutes talking about choosing the professional team, which really should be entitled Choosing the Right Professional Team. You know, exit planning is a team sport because there is no one advisor who has all the knowledge and experience to advise on a particular exit path or plan. Therefore, a critical step in executing an exit plan is to form a team of experienced advisors, each having a role and each contributing to the overall execution of the exit plan. Let's review who should be who should be part of this exit planning team. First of all, most likely and almost always, you'll have an attorney involved. The attorney typically provides advice on legal agreements in the transaction, as well as advice on estate planning. The attorney may also provide assistance with deal negotiations as well. Next, we have the CPA or the accountant, or he or she will essentially provide tax assessments for each exit strategy, perhaps prepare cash flow projections, and where needed, financial statements. Third advisor typically we find is a financial advisor. This typically is a CFP who will provide personal financial retirement projections and an investment strategy for the investment of the sales proceeds when there is a liquidity event. This professional is usually one of the first involved in the process, as they often help you measure any asset gap you have in your planning. Now, when I use the word asset gap, I'm referring to the difference between what you're going to need to retire and what you presently have, and if you can fill that gap with the sale of your business. This analysis helps you focus on what the value of your company needs to be if you're not already there, and also you can start working on building and protecting that value along the way, which, as we're talking about building and protecting value, is a good segue to the other advisor here, which is the insurance advisor. And that person's job is to make sure and to make recommendations on life, key man, disability, and business policies, all of which are designed to reduce risk and protect wealth just in case you become disabled or die along the way to exiting from your company. Of course, if you're going to sell your company to an outside third party, you're going to need an investment banker or an M&A advisor who will provide insights as to the current marketplace for sales transactions, give feedback on the viability of an external sale, as well as input on pricing. They also help you locate buyer candidates and also help you consummate the deal. The other advisor here, too, is that we need to speak about is the valuation advisor. The valuation advisor is very critical because it will help you understand the value of your business and also what drives that value. And you need to understand what those value drivers are, because if you need to grow the value of your business, you need to know what to work on. And finally, there are a number of advisors that I lump into the business consultant category. These folks typically can help you with improving the value drivers of your business so that it will be worth more. The value drivers that they can assist you with are developing a next-level management team, improving sales and profitability, documenting your business processes, and also technology upgrades. And of course, if you're in a family business, there are a multitude of issues that surface that only a trained professional can handle. So the key takeaway here is because this transaction and the sale of your business, that is probably one of the most significant financial events in your lifetime, it is critical that you have an advisory team to help you with that exit and with that sale. Again, there is no one advisor who has all this knowledge, so it is very important that you have a team. And as I said before, exit planning is essentially a team sport. Now, all right, now that we've talked about who the possible team members are, let's spend some time talking about what to look for in those team members. The first quality and first characteristic I would say you need to look for in your team members is the person needs to be a team player. Your advisory team must check their egos at the door and be willing to share thoughts and ideas with other professionals and accept input from other advisors. As the old saying goes, they must be willing to play well in the sandbox. Secondly, the team members must be both capable and experienced. The advisors must be experienced in working with business owners who have exited their companies. It's not good enough that they know a little bit about the technical aspects of a business exit. Knowing a little bit can be dangerous. Also, in this vein, the advisor needs to be the right fit given the size of the deal. And what I mean by that, and I can do is show you by example, if the deal is under $20 million, that size deal must be very important to the advisor. So using a local advisor as opposed to a national firm advisor may make more sense. With a deal this size, a national firm may staff the engagement with associates and not its most experienced advisors, and that could be to your detriment. And finally, too, inexperienced advisors can take, and often can take, non-standard positions, which in sales deals can be a real deal killer. And finally, responsiveness. As the saying goes, time is money. Well, when you consider how much wealth is at stake, delaying action and not being responsive causes the buyer to become uneasy, which could result in negative consequences for the deal, including killing it entirely. So the key takeaway here is not only do you need these qualities in your advisory team, but as I pointed out, and as you see as the last bullet, you also need a quarterback of the team whose job it is to coordinate the team's efforts to develop a plan consistent with your goals. And again, the quarterback can be any one of the advisory team members, as I previously mentioned. Okay, let's address what I've often found to be the biggest objection to having an advisory team, that being that it's just too expensive. Business owners have often asked me why they need all these high-priced advisors. Well, they believe that they know a little bit about the process and don't see the value of an advisory team. You know, my response then is that when you consider how much wealth is at stake when you sell your company and how mistakes can cost you a multiple of the dollar amount of those mistakes, given that companies are sold at a multiple of earnings, this is not the time to become frugal. Your current advisors may have served you well in the past, but they may not have the depth or breadth of knowledge or experience necessary to handle the complexities of a business sale. So again, the point here is that the cost of thoroughly planning with an experienced advisory team pales in comparison to the amount of money you may leave on the table by being unprepared. So at this point of the webinar, I'm going to turn it over to Rick Becker, who will address, amongst other things, he'll address how to choose the best sell-side advisor for the sale of your business. Rick?
Michael, thank you, and I really appreciate you guys inviting me to join in your webinar series. I think Mike touched on some really good points as he was going through his presentation. It is a big step to hire an investment banker or even a broker because it's a one-time sale. It's the only time that you'll be using that person. There's no preconceived trust that's been able to be built. So most often this is done by recommendation or referral. It's why good investment bankers like to work with the best attorneys that they can, the best accountants, because I think what you're going to hear in our presentation today is it's mostly about planning, as Mike was talking about, and process. And if you plan for a good end result and you follow a well-proven process throughout the M&A journey, the end result can be exactly what you want it to be. So people have tried themselves. There are a bunch of entrepreneurs who have been on the market forever with that old saying, well, if someone offers me more than my house is worth, I'll be a seller. And we're here to tell you that doesn't yield the best net result. You can't just talk to one person. It's not like selling your home. Each business is unique. It's a living, breathing animal. And you want to get someone who understands your industry in an ideal sense, someone who can cover each and every meeting because they're local, or someone who you just have that personality fit that you mesh. And the only way to get those people, and that also have all the attributes that Mike was talking about in terms of ego and team player and the pieces that are important, what you really need to do is take time to get to know your investment banker or your broker and to take the time to meet them in advance. If they're not willing to come to you, that's not the right person. If they're not willing to invest 5 or 6 phone calls, if they're not willing to do a valuation, Mike talked about you should have a valuation done by a valuation professional or an attorney, but you should also hear what the view of the intermediary is in terms of valuation. All those items are typically important. When it comes down to making the right decision, some business brokers typically are no retainer, where investment bankers will charge a small retainer. Often it's said that, well, first and foremost, any charged retainer should be credited against success. So in the big scheme of things, if you're confident with the person you're choosing, it is not a time to be penny wise and pound foolish. Do they have to be local? No. You look at the attributes in total. As long as you're getting the senior level people that Mike was referring to, or people that you feel confident with, and that you know they can cover every meeting, because this is a series of meetings in the process, you should be able to get to the right result. The most important thing, though, is to have that team that Mike talked about. CPAs that just do your taxes and have never been involved in an M&A transaction, they can have a role in the transaction, but you really should get a good accountant who can run a net transaction for you at the beginning. To the same token, you may love your HR lawyer. The lawyer that you use for everything may have gotten you the best deal ever on your divorce. I can tell you that it's very hard to sell a business. It's hard to sell a business at a premium price, and the best way to do it is to get professionals who have done this, been there, and know or have seen personally most of the curveballs that come along the way. In terms of the goals of the M&A process, you really have to know where you're going. So once you select the right team, I think it's important not just to have a kickoff meeting and turn over the data and build your marketing materials, but to sit back and reflect. Where do I want to go? What type of buyer do I want? What's most important to me in this process? How long do I want to be active? For the last 3 to 5 years, it's been a wonderful seller's market. With the new tax law that was just passed in 2018, the belief is that the next 2 to 3 years should be very, very good for the M&A environment, at least until interest rates rise. With it being a seller's market, you can almost get what you want out of a transaction so long as you know what you want. And I think the reason Mike really spent the time talking about a team of advisors is to get those advisors to all weigh in, what they've seen, what has worked best. Not every deal works out. Some deals that don't work out for the buyer are still good for the seller. If you understand what's important, totality again, what's important to your employees, what's important to yourself, what's important to cash consideration, what would be important to your financial planner in terms of cash at closing versus potentially rolling some equity into the deal. That's a very important piece of the process. As you're about to think about going into this process, though, I would tell you the number one most important thing is to know how broad of a process you're going to so that you can maintain confidentiality. As soon as your competitors hear about things, and candidly, financial statements aren't going to be the reason that you're giving up too much confidentiality. Most people know who a lot of your customers are. People, if it's a competitive industry, as most entrepreneurs compete in today, and with the advent of the internet, they even know the margin. So really, what's the risk of confidentiality? First and foremost, we would tell you, if people hear that your M&A process is ongoing, and it's going on for a long time, and your competitors sell against you. And that really can affect your probability of success on a go-forward basis. So if you plan properly, you know what you want out of a result, and then you let your intermediary keep things on a close and confined time frame, you can maintain that confidentiality that leads to a good ultimate result by going broad enough, and yet still doesn't let people hear about the process ongoing. And you have to think about it from a competitor's point of view. If you have a very attractive property and someone wants to purchase it, it's not in their best interest to let the other people in the world know that it's out there. So when we make the expression time wounds all deals, it certainly is the case. But again, it's a 6 to 8 month process. Once you engage an intermediary and once you have your marketing materials kept, Mark Solomon is going to talk to you about the 75 to maybe even 90 days it takes to close a process, even once you get to letter of intent later on, and all the pieces to that. So this is truly a 6, 7, 8 month process. And if you stick to the process and stick to your timeline, you'll have the best ultimate results. When you think about ways that you can take your business, a financial buyer comes with less risk than talking to someone in the industry that you work in. Talking to individuals, talking to search funds that are out there and don't own anything today. Family offices want to hold a business longer than an individual private equity group, which is pretty much a 4 to 5 year time horizon. Some people care greatly about their people and getting their people stock options. That's much easier done with a financial buyer than a strategic buyer. One of the best buyers out there, because they're already financed, is what we like to call the hybrid. It's a strategic portfolio company within a financial buyer group. That private equity group has its own balance sheet, can move quickly, understands the industry, but can also maintain the highest level of confidentiality. But there's no one right group. You should certainly never talk to someone that causes risk to your business or even perceived risk. And you can decide up front, should we tier the buyers list? You don't have to go out to everyone day one. You can go tier 1, you can do tier 2, and you can also do the most important tier, which is we prefer not to talk to them ever. But only having these discussions with your advisors up front will the process yield the right net result. One of the keys, and why we really think a team of advisors knows best, is to make sure the buyer is qualified, has the cash, and can close within the time frame. You do not want to become a wounded duck from this process where you've gone all the way down the road, you've done all the right things, and your deal doesn't close. So probability of success or probability of a successful closing is something that should certainly be talked about in these pre-planning meetings. As you look at the goals and you concentrate on what you want out of a transaction, I'm here to tell you that most people want 100% cash at closing, fait accompli, we're done the deal, I get to go home and retire. Those deals are out there. They do appear, but they are not the majority. Most often, there are pieces of the puzzle, and Mark will go into details later on escrows, earnouts, contingencies. Some buyers really like the alignment where you hold a piece of the company going forward, even if you don't work there, just for the aligned nature of a transaction. You need to hear what's out there because most often that will lead to a more premium price if you give the buyer what they're searching for. You hear a lot of rules of thumb such as strategic buyers know my industry, they can work faster, and they'll always pay more. 10 years ago, 15 years ago, probably true. In today's market where there's so few good businesses and so much money chasing good deals, that's not always the case. If you really want that premium valuation for all the years of hard work that you've put in, it really is best to at least come in with an open mind, hear what the options are, and then discuss. If a contingent earnout is something that you would never be able to sleep on, then that shouldn't be part of the program, and it should be addressed up front in your marketing materials before you go out to the buyer universe. In terms of valuation, what people think is the absolute number one item in an M&A process, I guess the three of us are here today to tell you it's not the only item that you should be paying attention to. Far from. Often, if you run a good process, you can end up with multiple buyers in a process and multiple options. And very often, we see that the entrepreneur does not select the absolute highest offer. I would tell you it may be 30 to 40% of the time that someone chooses a deal that's close to the highest value, but not quite there, because it's a better deal. It's a better deal in totality for the employees, the qualitative issues, what an owner wants to do thereafter. So it's important to know what the fair market value is at the beginning. It's important not to lose sight of that and have it in writing and know that that's part of your goals. Most often, businesses trade on the last 12 months of earnings, or what's affectionately known as EBITDA, earnings before interest, taxes, depreciation, and amortization. But that's not always the case. Recurring revenue businesses, alarm monitoring, landscaping, they might trade 30 to 35 times monthly recurring revenue. Wholesale distributors are very much known for trading at 1 times revenue. Beer distributors sell based on a multiple of case volume. So there are certainly rules of thumb in an industry, but it's very much, I think it's just apparent and obvious that you have to know the metrics in your industry as well as how things trade. And you should get those answers up front before you spend the time and energy that it takes. So prepare for the sale outcome, know your EBITDA. Know your EBITDA not only for the last 12 months, but for the last 3 years, so you can appropriately help your banker sell the deal. There's a lot of myths. We already told you that myth number 1 is people always take the highest value. Myth number 2 is that, I mentioned before, it's not like selling a home. It's more complicated. It takes more energy. It takes more effort. It can take your time away from the business, and often businesses don't perform to their highest level during the months that it takes to run an appropriate M&A transaction. And that's something to be very cognizant of, because you really don't want, in that check period where a buyer's there, the business to decline. There are things you can do to improve valuation. It's not a stagnant task. One thing you can do is to talk to your CPA. If you got a compilation in the past, maybe you should move it up to a review. If you had a review, get that good housekeeping seal of approval of an audit. If you have customer concentration, maybe it's time to take a little lower margin sale to reduce the concentration piece a little bit. And the number one biggest thing people can do, if you have holes in management or as the entrepreneur you're too important to the business, back off a little bit. Elevate people. Give them titles. Bring people to the forefront so that a buyer can get more and more comfortable. Then it also is important to work with your CPA and to work with your banker to look at non-recurring items, shareholder perquisites, and things that would be different if someone else owned the business. We're talking about multiples of EBITDA and earnings. If you're getting 5 times, 6 times for your business and you find $150,000, that could be very close to $900,000 million of extra value at closing. It is worth the time to do, you don't have to do a full quality of earnings, but to know your numbers, spend the time and work on your add backs. Valuation timing of a process. What does the process entail? It depends on the size of the business. It depends on the industry. But on the whole, you don't want to give up confidentiality in the name right away. You should be working with a teaser. But at some point, to get that maximum value, you're going to have to sign that non-disclosure agreement, and you're going to have to give out further data, whether it's a confidential information memorandum or whether it's a package of some sort. But if you're dealing with a lawyer who's never done an NDA and is going to take a month to review what a standard NDA looks like, I'm here to tell you it's the wrong lawyer. In our world that the three of us operated, there are standard forms, standard documents that can make this process go very efficient. And at the end of the day, very, very, very few people ever will sue anyone over a confidentiality. And if you're talking to the right buyers and the right types of buyers, you shouldn't have leaks of confidentiality. The key, stay on the time frame. Know what the time frame is. Have it in writing so you can go back and refer to it. Sure, it never works perfectly that what's supposed to take 2 weeks doesn't take 2 weeks and a couple days. But if you don't stick to a time frame and look back at it, sometimes this process can wear on. It's a once in a lifetime for a corporate entity. You should know when you're off track so you can talk to your advisors and try to get back on the road of trying to stick to the time frame of a closing. Remember, too, you have leverage throughout. Up until the day before closing, you don't have to sell, but you have your most leverage prior to signing a letter of intent. You're talking to the field. You're the attractive guy or gal at the dance. Once you sign that letter of intent that often has exclusivity, the leverage changes, and you really have to be cognizant of that and really feel secure about the type of buyer you're selecting for an LOI. There are a lot of pieces to the puzzle. Mark's going to get into some real depth. You need to take the time to understand the depth, and that's what we're trying to accomplish for you today. Whether it's knowing what you want in a lease, that one's easy. Knowing what you want in working capital and how working capital works and what assets go with the business and which ones do not, that's hard. Figuring out an employment agreement sounds so easy. Trust me, if you're a 45-year-old and someone's looking for 5 years of how they can tie you up, it's not quite that easy. Mark will go through some of these as we finish our presentation. Knowing how you can effectively and efficiently get data to people. Are you going to have an online in the cloud data room? It's critical. Maintaining a backup plan for throwing a buyer out of the process, and how long do you have to sit because you've given up the exclusivity. All of that's extremely important, and the good news today, I've mentioned it once, is multiples are at a real high. The bad news, because of that, buyers really kicked the can very hard in the due diligence process, because what might have been a small speed bump at 4 times earning looks like a mountain at 6 times earnings. So if you work with your advisors and you know what speed bumps are coming, it will help a lot. The last thing that I would say is valuation, timing, process, with a key not on valuation, but on process and timing. You can go broad. It often doesn't pay to put ads out there. No one should be advertising in the Wall Street Journal today, but there are, for smaller businesses, there are bulletin boards and there are secure sites that you can use, an Axial, Deal Nexus, that are really somewhat effective. And again, it's not to save costs, it's just to do the right marketing. An exclusive approach where someone says, oh, you should just talk to ABC Capital down the street, very, very difficult. What if you get an offer of 5 times EBITDA? How do you know in a vacuum if that's right? You only know if you run the process, get multiple offers, and then know what the time frame is from those offers, and they've done a decent amount of work to get you to the promised land. So I've mentioned that Mark's going to jump in. Mark, I'll turn it over to you. You're really one of the best detail guys. Take them from my high-level investment banker to what a good lawyer will do to close a process.
Thank you very much, Rick and Mike. Appreciate participating today. One of the things that Rick was talking about is many times you will not take the highest offer for your business. Really need to take a look at all of the payment terms and the likelihood of receiving those funds. When you get a purchase offer, it's going to have cash at closing, there's going to be adjustments, there's going to be deferred payments, and there's going to be contingent payments. Let's start with the adjustments at closing. Many times a buyer is going to want you to keep working capital in the company at a normalized level, meaning that they will not have to come out of pocket to be able to operate the business during the first few months. There's going to be enough cash and enough other current assets involved so that the company can be self-sufficient in that regard. Need to pay attention to what is the formula for working capital. Is that reasonable? A working capital target needs to be established, and there needs to be an understanding of what requirements you're going to have to meet when you close with respect to how much money, how much receivables, payables, etc. are going to need to be left into the company. Another thing that I always ask clients to think about is if there is any long-term debt or lease obligations, whether there's equipment, whether there's vehicles that are either financed or leased, can we get the buyer to take over these leases or these contracts? Otherwise, you're going to have to pay them off at closing, and that is going to, of course, reduce substantially the cash that you're going to receive at closing. In all of these transactions, pretty much, is going to be escrows established. A portion of the purchase price is going to be set aside based upon specific conditions in the future. The most likely escrow would be an escrow in a situation to secure indemnification obligations. You're going to be making reps and warranties in the purchase agreement and the closing document, and if any of those representations are not deemed to be true, the buyer may have a claim for indemnification, and there's going to be escrow proceeds set aside for that. We want to take a look at how long are they going to be set aside for, what is the amount of the proceeds that are going to be set aside, and what are the limitations that we're putting on those escrowed funds. There may be additional escrows if there's other liability claims that are out there, if there's resolutions of lawsuits that need to take place. So all of this is going to take away from the cash at closing. It needs to be properly understood and evaluated. There may be deferred payments. In many transactions, you're going to be asked to take a seller note. A lot of it depends upon what's the size of the note with respect to the percentage of the purchase price. Are you taking a note in a first position or in a subordinate position? Very important. Is that note going to have a first lien on the assets of the business, or is that note going to be secured by a second or third lien, which is going to be subordinated to a lien held by a senior lender? The question, of course, is what is the likelihood of getting paid under the note? A lot of it depends upon what position you're in, who you're subordinated to, and what are the terms of that subordination. So there's a calculation that needs to take place again if, in fact, there would be some cash flow issues with regard to the buyer after they purchased your business. Would there be enough of cash available to pay you on your note? And what security do you have to get paid? What guarantees do you have to get paid? So there's a lot of thinking and a lot of thought process that goes into doing all of this. The next question is you may end up selling and you may take back some equity in the purchasing entity. This may make a lot of sense. A lot of sellers like this because they feel as though if the business is going to be properly managed and eventually the EBITDA is going to grow and they're going to sell the business in the future to an institutional buyer, there may be a significantly higher valuation at a higher multiple, and this will afford you the opportunity to get a second bite at the apple. All that may be good, but again, a lot of it goes to what's the confidence that you would have in the management team going forward to be able to improve the performance of the business so that that rollover equity would be more valuable in the future than it would be presently. A lot of what I look at and say is when you're evaluating all these different variables in an offer, I think it really behooves you to look at what's going to happen in the future. If you look back on the transaction 3 or 5 years down the road, what is the likelihood of receiving all or a portion of the deferred payments and contingent payments? You've got to be able to, I think, to make an assessment of what is the downside, what is the likely scenario, and does it make sense? How much risk is involved in accepting these forms of payment, which are not cash at closing? Contingent payments are usually what we talk about in terms of an earnout. An earnout would be a portion of the purchase price being paid based upon the future performance of the buyer. There has to be a compelling reason for an earnout. If you're willing to accept an earnout, it probably relates to the fact that you either had some inconsistencies in your financial performance over the last several years. You may have a customer concentration issue, as Rick has mentioned, or you may be in a regulated industry where healthcare, for instance, there are a lot of reimbursement changes that go on that may affect the financial performance of the company going forward, and there may be somewhat of an earnout put in order to protect the buyer in those situations. One of the best things to think about is to begin the due diligence process before you list the business with a firm such as Rick's. Do some internal investigation, due diligence on your own business prior to putting it on the market. By doing this, you will be able to identify the weaknesses in your company which may raise red flags that will be disconcerting to a buyer and its due diligence team once the business is put on the market. These types of red flags, if not identified earlier enough, can lead to less cash at closing, can lead to a higher escrow for indemnification, can lead to an earnout, or could even lead to a buyer not moving forward to pursue the acquisition. It's important to be proactive. When issues are identified, there's an opportunity to explain them up front to the buyer and the due diligence team. You have an opportunity to work on resolving or at least diminishing the impact of these issues prior to the beginning of the sales process. Some common issues are pending litigation or administrative actions against the company. It is very common for companies, larger companies, successful companies, to have lawsuits. It's important to be able to articulate your position with regard to the litigation. Yes, our company has been sued, but this is what happened, and this is our legal position, and this is why we're confident in our legal position. The buyer's counsel will try to get their arms around the potential exposure, will want to speak to your attorney who's representing you in that particular suit. But if disclosed up front with a solid rationale for the legal defense, it is very likely that the buyer will go forward and that you will be able to work out a situation where the risk is properly shared between the parties with respect to that action. There may be judgments, there may be tax liens against the company. I had a client not that long ago that had $8 or $9 million in federal tax liens against it. And we were able to explain the circumstances behind the liens, and it did not spook the private equity group. They understood that sometimes bad things happen to good people and circumstances arise, and they understood the situation because we explained it up front to them in a way that made sense. Many times you may find, or other sellers may find, that it's difficult to assign key customer or supplier contracts. This needs to be thought of up front. If we're not able to get certain contracts assigned, then what can we do? Okay, what can you and your team do to make the buyer comfortable that they will get the benefit of the revenue without formally assigning the contract? You may find in your company that you don't have non-competition agreements with certain of your key managers and salespeople. Well, that's something that we want to address up front. As Rick and Mike mentioned, having a strong management team, having them under non-competition agreements, employment agreements, incentive compensation agreements is all important. If we don't have non-competes, we need to get these key people under reasonable non-competition agreements prior to putting the business on the market. Because you don't want any of your key people to hold you up and to extract greater concessions from you because the buyer will not move forward without these agreements being in place. Always important to, of course, maintain all licenses, understand the expiration dates of certain contracts, protect intellectual properties. These are some of the issues that, if dealt with up front, can allow you to better position your company when it's put on the market to be able to command a higher price because you don't have these red flags that are out there that the buyer is going to be concerned about and which are going to affect the negotiations. Indemnification claims. One of the things I say to clients all the time is that you've got great people that represent you, people like Rick and Mike. They can put the deals together, but the real devil is in the detail with regard to the reps and warranties that you're going to make under these contract documents. Because, God forbid, if the buyer buys the business and it doesn't do well, they're going to be looking for a way to bring an action against you, if at all possible. Indemnification goes to allocation of risk. A buyer wants the benefit of the bargain. They want full disclosure. They do not want surprises. You do not want to make representations that are overly broad or that you do not know whether they are true or not, or that you do not have control over. Many of these claims are going to relate to ownership of the assets being free and clear. They're going to relate to the accuracy of the tax returns and financial statements, with the business being in compliance with all laws, with all permits and licenses being in place, the fact that you don't have any breach of any of your contracts or leases, that there's no pending or threatened litigation, that all material information has been disclosed to the buyer. What you would want to do is to be able to restrict these representations only matters which you are aware of whenever possible and which are material to the transaction. For instance, to the best of my knowledge, the company is in compliance with all applicable laws. There may be laws out there that you're not even aware of, okay? But to the best of your knowledge, you are in compliance with all applicable laws. No violation exists of any applicable laws which would have a material adverse effect upon the business. This is the language that lawyers use that are experienced in these types of transactions, and they can be extremely important when interpreting these provisions in a situation where the buyer may be making an indemnification claim. In terms of indemnifications, we want to be able to limit the total amount that the buyer would be able to go after your company in the event that there was a proven material misrepresentation or omission. Never want to go ahead and allow the buyer to bring an action for an unlimited amount of money, for an amount of money that exceeds the purchase price, for an amount of money that exceeds the cash payment at closing. Want to limit the term of these indemnification provisions to 1 or 2 years after the closing. There are certain what we call fundamental representations, such as the authority to sell, the assets of the stock, taxes, environmental issues, where the buyer may seek to have those representations stay in place for a longer period of time, even as long as the statute of limitation exists. Also would like to set some type of a basket or what I call deductible. In other words, you don't want the buyer to come after you for $400 here, $800 there. There needs to be a minimum amount of losses. It could be $25,000, $50,000, $75,000, depending upon the nature of the transaction. Only when the amount of the total claims exceeds that minimum amount can an action for indemnification be undertaken. Security for indemnification, the most common type is to have a separate escrow set aside for a period of time. Could be 12, 18, 24 months. And this really acts as an insurance policy so that the buyer, if there is a legitimate claim, they will have the opportunity to go after a source of funds in order to make good on that indemnification obligation that you made, rather than having to initiate a suit in order to recover funds. The key, though, is that indemnification should only take place after a provable loss has been suffered. It needs to show that a loss has been incurred, that the buyer is going to pay or has to pay. You must be given notice in advance prior to any settlement or any payment of any claim, and an opportunity to settle or defend that action. In other words, a process goes through that is laid out that if the buyer believes that there is a claim, you're going to have the opportunity to settle it, negotiate it, defend it, and until such time as it is resolved, there will be no money taken out of escrow. There will be no offset against any payments due under a promissory note to you. There is a process that has to be abided by, and try to put limitations in place so that, again, unless there's a proven loss that is actually suffered and paid for by the buyer, okay, that is not covered by insurance, there should not be any money taken back or any way to move forward in order to collect on that indemnification claim.
Thank you, Mark. Thank you very much. I'm going to spend a little time now talking about some of the tax and accounting issues and considerations involved with selling your business. And I'm going to start by talking at a very high level about the due diligence process. You know, due diligence is a lot of things, but it's also a process of first impressions. And as the saying goes, you only have one chance to make a good first impression. So with that said, if you're unprepared, if you're not responsive, and if you can't explain what's in your records or your financial statements, you raise doubt in the mind of the buyer, which could negatively impact pricing or even having a deal at all. So the key takeaway here is make sure you're prepared so you can respond accurately and timely. Also, from a CPA perspective, if you plan on selling your company to an outside third party, you should have audited financial statements for the 3-year period prior to the sale. And finally, I would also mention that you pay attention to some of the state and local tax filings and issues, because If you don't clean them up before the buyer does due diligence and uncovers them, you're going to have some problems. And I've seen this very, very often and very recently, where there have been sellers who have ignored their state and local tax filings, waiting for the states to catch up with them. This is not a good strategy. If the states don't catch you, I can almost assure you that the buyer's due diligence team will, and oftentimes they will ask you and they will set aside money in escrow until these matters are cleared up. So the message here is be proactive with these state and local tax matters and make sure you clean them up before the buyer finds them, because if you don't, you're essentially giving the buyer more leverage in the pricing of the transaction. And then, let's talk about the transaction in general. At a very high level, you as the business owner need to be mindful of the fact that for the professional buyer, which is oftentimes a private equity firm, the transaction is commonplace. They've been here before. But for most of you, this is a once-in-a-lifetime experience with significant liquidity and consequently with significant tax consequences. And for this reason, proper tax planning is necessary and can significantly enhance your after-tax cash flow from the sale. And again, in my experience from the CPA perspective, I get this question all the time when someone goes down this process of selling their business. And the question is, how much cash will I walk away with after taxes? So let's talk a little bit about some of the tax considerations in a sale to an outside third party at a very high level. Most of the times, the transactions that I see are structured as asset sales for a variety of legal and tax reasons. For tax purposes, asset sales are more desirable than stock sales in that the buyer can get a basis step up for the assets of the business equal to the amount paid for the business. This does not happen when they buy stock. Also, for legal reasons, buyers are hesitant to buy stock in that they assume, when they do so, they assume all the known and unknown liabilities of the seller, which most are adverse to. The major issue when you have an asset sale centers around the allocation of the purchase price among the assets acquired. The buyer and the seller are often at odds here, and what benefits one will often be to the other's detriment. The Treasury regulations here list 7 asset classes to which the purchase price can be allocated, and each has its own tax treatment. Some assets are ordinary income assets, where any gain on the sale will generate ordinary income, which is bad for you, the seller, but could be good for the buyer. An example of this type of asset is inventory or even depreciable property. The buyer will typically want to allocate as much as possible to either inventory depreciable property because they can almost immediately write off its cost. And now with the new tax bill, you can bet that buyers will be pushing hard for more of the price to be allocated to depreciable property, since under the new law, they can write off 100% at the time of acquisition. So you got to be careful of this, because if they do this, you as the seller will be recognizing ordinary income. Now, there are also other asset categories that are capital gain assets, where any gain is taxed at the preferential capital gain rate of 20%. This is good for you, but not so good for the buyer, as these assets for the buyer must be amortized on a straight line basis over 15 years. And these assets are typically intangibles such as goodwill, customer lists, going concern value, etc. So be mindful of that, and also keep this in mind as well. To keep everyone honest, the tax law requires both the seller and the buyer to report the allocation of the purchase price on Form 8594, and the amounts must be consistent. If they're not consistent, it could trigger an audit, and the IRS can match them, as each party has to identify each other when they file the form. So the key takeaways here with regard to asset allocation is, the asset allocation issue should be addressed and agreed to upfront and early on, and documented in the purchase agreement. Do not leave it up to chance. Secondly, it may make sense for this Form 8594 to be completed as part of the closing document, so that it's consistent for both the buyer and the seller, and then both the buyer and the seller agree to attach that form to their tax returns in the year of sale. And finally, as the seller, you need to seek to allocate to your ordinary income assets, which are inventory, accounts receivable, depreciable property. You need to allocate amounts equal to your tax book value, so that you will have no ordinary income on the transaction with regard to those assets. And you should also seek to allocate the balance of the purchase price to your intangibles, which would be taxed at preferential capital gains rates of 20%. The tax savings here could be significant. Let's talk a little bit about partnerships. And, partnerships, or most notably LLCs, which are taxed as partnerships, are very popular, and they've become very popular over the last 20 years as a business form for a variety of reasons. First of all, there's only one level of tax when you're operating through an LLC, and when the assets are sold, there's, again, only one level of tax. And furthermore, the character of the gain on the sale of the assets retains its character. So if you're selling intangibles and you're in an LLC format, the intangible gain will be taxed as capital gain at 20%. And also, another unique benefit of the LLC is that when the buyer acquires an LLC interest, they can obtain a basis step-up in the underlying assets to reflect the price paid for the interest. So this transaction is almost akin to them buying the assets outright. The seller, though, on the other hand, is treated as selling their interest in the LLC, which is normally a capital asset, which would generally generate capital gain income. However, there is a trap here that you need to be aware of, and that trap is this issue and this concept of unrealized receivables. Under partnership tax law, any gain on the sale of your LLC or partnership interest will be recharacterized as ordinary income to the extent that there are any unrealized receivables held by the partnership at the time of sale. Now, unrealized receivables is kind of a deceptive term because it doesn't only include accounts receivable that have not been previously reported as income, but it also includes things like prior depreciation taken, and also unearned or deferred revenue for those of you on the accrual method. So the key takeaway here is that even though you as an LLC owner are selling your LLC or partnership interest, all of your gain may not be capital gain taxed at 20% due to this unrealized receivable issue. You need to pay attention to how the buyer will allocate his purchase price to the assets acquired, as this will affect how much tax you will pay on the transaction. Don't just assume that you'll all have capital gain, because that's not going to be the case. And finally, with regard to S corporations, and many folks do operate through an S corporation these days, if your company is an S corporation and an asset sale would be too cumbersome, be aware that the buyer can still buy your S corporation shares and get a basis step up for the assets acquired. They can do this. There's a code provision, and I've cited here, it's 338H10, and it's an election that can be made where you and the buyer agree to treat your stock sale as if the assets of the company were sold for their fair market value, thus giving the buyer a basis step up in the assets. And as far as you're concerned, you as the seller will be treated as having sold the S corporation assets, so that not all the gain will be treated as capital gain, and the purchase price allocation, again, becomes very important, even though you're selling stock. So the key takeaway here, again, is that if you're an S corporation and you're agreeing to this 338H10 election, as the seller, you still need to focus on the allocation of the purchase price, as the transaction, even though it's a stock sale, will be recast for tax purposes as an asset sale, and there could be ordinary income in the transaction. So at a very high level, these are some of the tax and accounting considerations that I would like to share, that I have shared with you, and I think you need to be aware of them. And I'll now turn the program over to Mark, who is going to talk a little bit about post-closing consideration. Mark?
Thank you, Mike. Post-closing considerations are extremely important. The day that the closing occurs is not the end of the receipt of the stream of income in most cases. There's ongoing obligations by both parties. It's really important to understand your role immediately after the closing of the transaction. If you're going to stay on in management and you're going to enter into an employment agreement, then you're serving as an employee. If you have taken a seller note, a note back from the buyer, okay, as part of the consideration for the purchase, you are a creditor. If you have taken rollover equity, you are a partner. So there's several different hats that you're wearing, and it's important to be cognizant of all of those and how they interact with one another. For instance, signing an employment agreement. First thing that I would look at, you can look at the term of the agreement, but of course, you have to consider the termination provisions. What happens if the buyer, your new employer, decides to terminate you? What are the conditions for terminating you with cause? What happens if they terminate you without cause just because they're not happy with your performance and decide one day that they no longer need you? What do they have to pay you? What's the severance? Are they going to pay you the balance of the compensation due to you through the end of the term of the agreement, or are they going to pay you several months or a year or a fixed amount of compensation based upon that early termination? Also extremely important, if in fact there's an earnout, if in fact there's rollover equity, you most likely want to stay involved in the management of that company. You have a vested stake in that company performing well. I believe it's much riskier to deal with an earnout or to deal with rollover equity if you're not involved in actively participating in the company. Now you're passive and you have no rights, you don't know what's going on. It's going to be much more difficult to get your arms around what has happened and why you're not getting paid on a note, getting paid on an earnout, and so forth. When you're involved in the management team, you are, at least to some degree, controlling your destiny. And therefore, if there is going to be rollover equity, you would want to cash out that rollover equity through a put option if your employment was terminated. You don't want it anymore. You can invest in every liquid company on the New York Stock Exchange. What do you need to be a passive investor in this privately held company for? So there are options that are open to you, and a lot of this needs to be negotiated based upon what future contingencies may occur. Operating agreement. If you are going to take a minority position in the NewCo, you want to have some minority member or shareholder protections built into the agreement if at all possible. Dilution should only occur on a pro rata basis. You'd like to have tag-along rights. Therefore, if the majority sold, you'd like to be able to sell your interest at the same rate. You want to have some type, if possible, approval over certain of the most important decisions affecting that company, such as selling substantially all its assets, or merging it, or filing for bankruptcy, or dissolving the company. Those types of major decisions you would like to be made by a supermajority or a unanimous vote of the different members. Earnout, again, like to be able to stay in control your own destiny. If the earnout is based upon EBITDA, then again, going back to the purchase contract, you want to negotiate a formula that makes sense based upon normal operating expenses, not including one-time expenses, putting ceilings on executive salaries and management fees. All of these things come down to details, and again, it's a lot more than what the purchase price under the contract is. It's a lot more involved than simply what the cash is at closing. There's a lot of variables that need to be considered in terms of evaluating what is the best offer and what offer is likely to allow you to recognize the most money through the transaction over time.
And as we're coming to the end of the program, it probably makes some sense to summarize. Just a lot of what you heard today probably can sound very complicated, confusing at times, and to a great extent it can be. Selling a business is hard. None of us are going to shy from that, but you do have to remember businesses are sold each and every day. Wonderful outcomes are on the horizon. Converting capital gains from ordinary income is certainly a very attractive piece, and the ability to slow down when the time is right for you. So if you can see that light at the end of the tunnel, just because it's hard doesn't mean it's not something that you should step up and give a swing at if the time is ready for you personally. There are probably 3 reasons why business acquisition opportunities fail and do not consummate. Studies show that maybe the number 1 piece is just you weren't prepared for the process. Your accounting wasn't in shape. Your contract didn't have assignment clauses. Many of the pitfalls that Mark and Michael talked about today just weren't addressed up front, and maybe it could be sold, it just wasn't the right time in that process. The number 2 reason is it's a 6 to 8 month process, sometimes even longer, once you get on board and find that buyer. And what needs to happen in those 3 or 4 months where the buyer is conducting their due diligence, you have to hit your numbers. You have to show that you're a stable business, ideally a growth business. And if you put projections out there and you miss on those, it really makes the process of consummating much more difficult. And then the 3rd reason, we've already cautioned the business owner about this. These can be standard forms. These are issues that are there in each and every transaction. If you get a lawyer who does this time and time again and is familiar with the process, familiar with the procedures, knows what the standards and norms are, and isn't creating issues when issues shouldn't have been there in the first place, these are deals that can consummate. The last thought we would give you as a team is trust your process, trust your advisors. Don't lose patience if things drag on a little bit. We have a saying at our shop that when you think you know things are going to happen, always take the over in terms of time. Things take a little bit more time than you think, but we're here to tell you that if it can happen, it will happen, and there are net positive results by going through an M&A process.
Thank you, Rick. Thank you, Mark. That was very insightful. And thank you all for attending today. Be on the lookout and stay tuned for our next webinar on the topic of business continuity planning, which will deal with your contingency plans should something happen to you before you plan on exiting your business.